You ever get that feeling there are some stocks out there just waiting to take off, the kind of move that could really pump up your portfolio?
Yeah, that allure of doubling your money, it's strong.
We're talking about that real pull, right? And who isn't looking for that kind of knowledge, smart and, fast?
That ambition for, well, significant growth is definitely understandable. What's crucial, though, is moving beyond just hoping for big wins
Right.
and
Right.
starting to think strategically about where those opportunities might actually lie in the market, you know?
Absolutely. That's pretty much the mission we're on today. Forget about like random picks.
Hmm.
This isn't about some flash in the pan tips, it's a deep dive. We're looking at a set of expert viewpoints focused on pinpointing those potential big movers.
Yeah, getting under the hood.
Our goal today is sharp, to really understand the thinking behind which stocks could potentially double. Based on the work of analysts who are tracking this stuff day in, day out,
Yeah.
we're cutting through the surface level to get you to the core insights without, hopefully, drowning you in data.
And the main perspective we're using to guide this exploration, it comes from Wall Street analysts. We'll be looking at their recent analysis, market trends, specific companies.
With a focus on that upside, right? The ones they think could really move.
Exactly. Those they believe have significant upside potential.
Okay, let's dive right in then. The analysis we're looking at highlights something interesting. Instead of just that old idea that a rising market lifts all stocks,
The rising tide lifts all boats, yeah.
it points to specific sectors where we might see a much bigger wave, maybe like a tsunami of profits, as they put it. What's the key takeaway there?
Well, the fundamental idea is just how important it is to first understand which sectors of the market are primed for substantial growth.
Okay.
By identifying these areas first, you significantly improve your odds, your chances of finding individual stocks with that potential for outsized returns. It's about aiming your search where conditions look most favorable.
Makes sense. And to help us do that, the analysis points to a resource called FactSet Earnings Insight. You can find this with a quick search online. It's a weekly rundown of S&P 500 earnings estimates. What makes this so useful for investors? Like, why is it a cheat code?
What's really insightful here is the top-down view it provides.
Okay.
By looking at expected earnings growth and, crucially, how expensive different sectors are as a whole, you get this valuable overview of the market landscape.
Get the map.
Yeah, it's almost like having a strategic map. Shows you the most promising territories before you zoom in on specific locations,
Right.
And even if you don't pinpoint the single best stock in a strong sector, just being invested in that sector increases your likelihood of good results.
So what's the current picture from this FactSet data? How do analysts see sector earnings growing? I gather there have been some downward adjustments lately.
That's right. Overall, analysts become more cautious about earnings growth across most sectors.
Why is that?
Factors like a softening economy, tariffs kicking in, maybe weaker consumer confidence. It's led to these revised expectations. Yeah. But it's important to note, some sectors are proving more resilient than others. They're holding up better.
Which sectors are currently looking the strongest in terms of that expected earnings growth, according to this analysis?
Technology and healthcare are standing out. They've got the highest projected earnings growth.
Okay.
Financials and utilities are also showing relative strength in this environment.
Now, just because a sector is predicted to grow a lot, does that automatically make its stocks good investments right now? That's where we need to consider how expensive those stocks already are, isn't it?
Precisely. Yeah, this brings up a crucial point. The forward price-to-earnings ratio, the PE ratio.
Explain that a bit.
It basically tells us how much investors are currently paying for each dollar of expected future earnings, whether it's for a whole sector or an individual stock.
And a high PE might mean trouble, or at least less upside.
Well, it can suggest that a sector is already priced pretty optimistically,
Hmm.
which could potentially limit future gains, yeah.
And how do the current PE ratios of these sectors stack up against, their history?
Right, connecting this to a broader perspective. Comparing current sector PEs to their average over the past 10 years, that helps us see if a sector is trading at a premium or maybe a discount.
And what's the story there?
Interestingly, the analysis highlights that only real estate, utilities, and energy are currently trading at a discount to their long-term averages.
Why would that be?
Well, this discount often reflects lower anticipated growth in those sectors. Or, in the case of utilities and real estate, they tend to be pretty sensitive to interest rate changes.
So it's not as simple as just chasing high growth or snapping up cheap stocks. You need that balance.
Exactly. That's the sweet spot, really.
Yeah.
Strong growth combined with a reasonable valuation.
Yeah.
That's often the most attractive scenario.
Because paying too much cancels out the growth potential.
It can, yeah. Paying a high price,
Yeah.
even for high growth, can definitely eat into your potential returns.
And the analysis we looked at points to healthcare as a particularly interesting sector in this regard. Why is that?
Well, an interesting point here is that healthcare is projected to have the second highest earnings growth, around 18%.
Pretty strong.
Yeah, but also it has a valuation that is relatively inexpensive compared to its historical norms.
Ah, so growth and relative value.
Exactly. This unusual combination, strong growth and relatively low valuation. It suggests the market might be overlooking its defensive characteristics, especially during economic uncertainty. So it could present a potentially less risky entry point for long-term investors.
Any specific names mentioned?
The analysis mentions Merck, Eli Lilly, CVS Health, that's ticker CDS and Humana, as examples that have been discussed previously in this kind of context.
Okay. What about those sectors trading at a discount? Real estate, utilities, energy. What's the story behind their lower valuation? Is it just slow growth?
Pretty much, yeah.
Oh.
As we touched on, their expected earnings growth is considerably lower.
How low?
Well, in fact, for real estate and energy, the anticipated profit growth is actually below the rate of inflation.
Ouch. So even if they grow, you're losing purchasing power.
Potentially, yes.
Wow.
Any nominal gains might not translate to real increases.
And technology. Despite its higher valuation, it's still seen as appealing because of the growth.
That's the key takeaway, yeah. While tech stocks are currently priced at a premium, no doubt about it, the robust expected earnings growth in the sector continues to make it an attractive area for potential investment.
Right.
The analysis even refers back to a previous discussion we had about 5 specific tech stocks with millionaire-making potential.
I remember that. Broadcom was one, right?
Yeah, Broadcom, AVGO, and Palo Alto Networks, P&W, and cybersecurity were mentioned. Big potential there, according to that analysis.
Okay, so for anyone listening who wants to do their own digging into these sectors, the analysis mentions sector spiders. What is that, and how can people use it?
Sector Spiders, which you can find at sectorspiders.com, is a really useful resource. It helps you track how different sectors are performing. But importantly, it also shows you which companies within the S&P 500 make up each sector.
Ah, so you can drill down.
Exactly. Once you've identified a sector that looks promising based on earnings growth, valuation, whatever, you can use Sector Spiders as a starting point to find individual companies within that sector for further research.
Got examples.
Sure. You can see the major players in healthcare like AbbVie, Eli Lilly, CVS, or leading tech companies like Palo Alto and CrowdStrike. It just gives you names to start investigating.
Okay, so we've looked at the big picture with sector analysis, a top-down view. Now, the discussion shifts to individual companies specifically, the top 10 stocks that Wall Street analysts believe have the most potential to rise, maybe even double.
Right, the bottom-up approach.
What's the critical thing we need to remember when looking at these lists, though? Is it just buy these now?
No, definitely not. This is where a healthy dose of skepticism is really important.
Okay.
While these top 10 lists can offer some interesting ideas, maybe spark some research, they should not be taken as guaranteed winners.
Analysts can be wrong.
Absolutely.
Yeah.
Even the best ones aren't always right. It's crucial, really crucial, to do your own independent investigation into any stock that catches your eye.
Understanding the good and the bad.
Exactly. Understanding both the reasons for the optimistic outlook, the bull case, and the potential risks involved, the bear case.
Let's start with First Solar, FSLR. It's highlighted as having the potential to more than double. Wow. What's driving that kind of optimism?
Well, an interesting point about First Solar is its resilience, actually, in the face of recent market volatility, tariffs, and whatnot. While many stocks have taken a hit, First Solar has held up relatively well. That's likely due to its business being less exposed to tariffs compared to, say, Chinese competitors.
And the industry itself.
Despite some challenges in the solar industry as a whole, you had bankruptcies, issues with metering rules in California, Chinese panel dumping.
Yeah, it's been tough.
It has, but the long-term growth prospects for solar energy are still very strong, expected to grow like 15% annually through 2030.
And First Solar's position?
They're well-positioned. Significant market share, estimated around 21%, and a healthy backlog of orders. So they stand to benefit if that growth happens.
Okay. Next on the list is Decker's Outdoor, DECX, ticker DEC. A really significant potential upside, like 123%. But the analysis suggests some caution here. Why is that?
Yeah, that upside looks tempting, doesn't it? But the primary concern with Deckers is its reliance on supply chains in China and Vietnam.
Tariffs again?
Yep. Both countries have been subject to substantial tariff rates. And this has already impacted the stock price significantly. It dropped hard after the tariff news.
Even though it's done well historically.
It has. Great performance over 5 years, something like 633%. But these trade-related headwinds, they present a major challenge right now. It could require a lot of patience if you choose to invest.
Okay, heads up on that one. The analysis also includes a couple of airlines, United Airlines and Delta, both with potential to more than double, according to analysts. What are the risks we need to consider with these picks? Airlines feel risky.
They often are. Look, the airline industry is notoriously cyclical. It's prone to volatility.
Even with lower fuel costs.
Regardless of short-term factors like lower jet fuel prices, yeah. Their history includes periods of significant financial distress, near bankruptcies even. Remember that?
Oh, yeah.
You could look at the U.S. Global Jets ETF, ticker GGTs. Pretty flat performance over 5 years. Tells you something.
But Delta had a good quarter recently.
It did, but the stock's still down quite a bit for the year. So these might be viewed as potentially shorter-term trades based on those analyst targets rather than maybe core long-term holds. Higher risk.
Got it. Finally, in this top 10, we have NVIDIA, NVDA, with a slightly less than 100% potential upside. So not quite double, but still huge. Why is this one highlighted as potentially a particularly good opportunity right now?
Right. Despite the slightly lower percentage upside compared to some others, NVIDIA is presented as a potentially compelling buy, mainly because its stock price has fallen so significantly this year, down like 33%.
So it's a value play now.
Potentially, yeah. That drop has brought its valuation down to a more attractive level relative to its growth prospects anyway.
What about earnings? They report soon, right?
They do. And there's potential for downward revisions in full-year sales expectations. That's a risk.
But even so.
But even with potentially lower sales, say $180 billion instead of higher estimates, the analysis suggests its price-to-sales ratio would still be significantly lower than last year, suggesting deep value, perhaps, given its underlying strength in data centers, AI, gaming.
Yeah.
It could be a good long-term value if you believe in the story.
Okay, interesting. Now, the discussion takes an interesting turn to the other end of the spectrum. 10 stocks that analysts are currently less optimistic about, the ones they're avoiding. What are the two key ways we can interpret this kind of information? It's not just sell these, is it?
No, not necessarily. There are a couple of important ways to look at this data. First, yeah, it gives us insight into the potential downsides, the bear case for these companies. Why are analysts expecting them to underperform? It helps you understand the risks.
And the second way?
Second, sometimes when sentiment becomes really negative on a stock and everyone's selling, it can actually create a contrarian opportunity. If you believe there's a possibility of a turnaround that the market isn't currently recognizing or pricing in.
Buying when there's blood in the streets kind of thing.
Sort of, yeah. But you need a very good reason to believe the crowd is wrong.
Let's touch on a few of these avoid stocks. First, Huntington Inglis, HII, shipbuilding, defense. What's the cautious outlook there? Why avoid it?
Well, it's not really expected to be a high-growth stock. That's the main thing.
Or it's stable.
It should be relatively stable, yeah. It's a major supplier to the U.S. Navy, huge backlog of orders. So you've got that defense spending underpinning it.
So why avoid?
The expectation is just for steady, if pretty unspectacular, revenue and earnings. Maybe boosted a bit by cost-cutting efforts, but probably not significant stock price appreciation. More of a stable dividend play maybe than a growth story.
Got it. Next up is Dollar General. DG. It's had some ups and downs in its stock price lately, hasn't it? What's the analysis suggesting here?
Yet, Dollar General's stock price has seen some real pressure over the past couple of years. It did show signs of recovery for a bit before the recent market-wide declines, tariffs, etc.
What are the challenges?
Well, while it has a massive store footprint, it faces pretty significant competition. Walmart, Amazon, other dollar stores.
And the earlier rebound, what caused that?
That was partly attributed to a strategic review of its store portfolio. They looked at closing underperforming stores, focusing expansion on more profitable areas. And that did show some positive momentum in sales figures recently, like same-store sales.
But the competition is still tough.
Exactly. The broader competitive landscape remains a big challenge for them.
Okay. Finally, the inclusion of Berkshire Hathaway, BRKB, on this list of stocks to avoid seems, well, surprising to me. Warren Buffett's company. What's the counter-argument to that negative outlook? I assume there is one.
Oh, yeah, that's a really interesting one. And I tend to agree it's surprising to see it on an avoid list based on typical analyst targets.
Why might analysts be down on it?
Well, Berkshire might not deliver the, explosive growth of some tech company. It's a huge, diversified holding company, almost like a value ETF in some ways.
So it lags in bull markets.
It tends to underperform in really strong bull markets, yeah. But the flip side is its resilience during market downturns.
How's it done this year?
Actually, it's been one of the better performers this year, while major indexes are down significantly. Up around 7% year-to-date last I checked.
And the long term.
Its long-term track record significantly outperforms the S&P 500 and the NASDAQ. Plus, you have Warren Buffett sitting on that enormous cash pile.
Ready to buy the dip.
Exactly. That positions Berkshire to potentially make strategic acquisitions of undervalued companies during market sell-offs like this one. They could ultimately drive its value well beyond current analyst expectations. So, yeah, disagreeing with the avoid target seems reasonable here.
So, okay, to bring it all together then, what are the key things our listeners should take away from this deep dive into analyst perspectives on stocks with big potential, maybe even potential to double?
I think the main points to remember are, first, the value of starting your research by looking at those broader sector trends. Don't just jump to individual stocks immediately.
Use resources like FactSet.
Yeah, use resources like FactSet Earnings Insight to get that initial overview. Then examine those individual stock picks, both the ones with high hopes, the potential doublers, and those with more cautious outlooks.
But not as a shopping list.
Definitely not.
Okay.
View them as starting points for your own thorough due diligence. It's really vital to approach analyst opinions with a critical eye. Understand they are just one piece of the puzzle when you're making investment decisions.
Absolutely. We really hope this deep dive has given you a solid framework for further investigation, maybe sparked some ideas. Remember, nothing we've discussed today is financial advice.
Okay.
And doing your own in-depth research is always the most important step before making any investment choices.
And maybe one final thought for you to mull over. Just consider how unexpected shifts in the economy, like that tariff crash we mentioned, or other unforeseen events, how they can significantly alter the prospects of even the most carefully analyzed stocks and sectors.
Yeah, things change fast.
They really do.
Yeah.
It just underscores the constantly evolving nature of the market and the ongoing need for you as an investor to keep learning and adapt.